The global fight for financial dominance has entered a dangerous new chapter. Across Asia, China is quietly reshaping the world's money flow, not with weapons or armies, but with trade deals that rewrite the rules of power. One by one, nations are beginning to settle their exports in yuan, drifting away from the dollar that once anchored every major transaction. In Washington, the mood is shifting from concern to panic. The U.S. Treasury has just funneled $20 billion into Argentina's collapsing economy, not as a gesture of kindness, but as a defensive move to protect the dollar's fading reach in South America. It's less about saving Buenos Aires and more about saving influence. Every dollar sent overseas now feels like a measure of America's weakening grip as rivals build their own systems designed to function without it. While Beijing expands its reach through trade and currency control, Washington is burning through billions just to hold its ground. From Argentina's peso turmoil to Japan's struggling yen, the financial balance of the world is cracking piece by piece. Then came China's next power play, a move once thought impossible. Beijing abruptly halted all new Iran ore shipments from BHP Group, the world's largest mining company. The directive came from the state-run China Mineral Resources Group, or CMRG, a trading powerhouse created to give Beijing greater command over global commodity prices. Every Chinese steelmaker was told to stop buying new dollar-based BHP shipments. Even vessels already en route from Australia were frozen unless revalued in yuan. Overnight, the world's most crucial industrial supply chain was disrupted. China, which consumes nearly 70% of global seaborne iron ore, has long depended on BHP, Rio Tinto, and Vale to feed its massive steel industry. But that dependence is ending. With steel demand slowing a thumb and fresh supply coming from Guinea's Simandou project, Beijing finally feels strong enough to set the terms. Experts say this isn't just about price control. It's about currency dominance. By cutting off dollar transactions, China is forcing one of the world's biggest raw materials markets to move toward yuan-based trade. Iron ore, already priced in yuan, continues to move freely, making Beijing's message unmistakable. Trade with us, but do it in our currency. Markets reacted instantly. Singapore iron ore futures jumped nearly %, while BHP shares in London tumbled 5%, their steepest fall in months. It's another example of how China has learned to weaponize its economic leverage. Earlier this year, it restricted exports of rare earth metals vital to Western technology. Now it's striking at the foundation of modern industry itself, iron. CMRG, only 3 years old, is now carrying out Beijing's long-term strategy to shift the balance of resource pricing power away from foreign miners and toward Chinese control. The message to global markets couldn't be clearer. Access to China's vast industrial demand now comes with a condition: play by Beijing's currency rules. As China extends this model from metals to energy and agriculture, the pressure on the dollar will only intensify, setting up the next wave of Washington's desperate reactions. That desperation showed itself in a shocking move from the U.S. Treasury. Treasury Secretary Scott Bessent's $20 billion bailout for Argentina caught investors and lawmakers off guard. Officially, it was described as a plan to stabilize Argentina's collapsing peso. In truth, it revealed just how far Washington is willing to go to defend the dollar's shrinking sphere of control. The Treasury and Federal Reserve created a $20 billion swap line with Argentina's central bank and began directly buying pesos, a risky, almost unprecedented attempt to stop a free fall. But Argentina's economy is unraveling. In only 3 months, the peso has lost more than 20% of its value, plunging from 1,200 to 1,500 per dollar. Inflation has soared past 50%, and the country's reserves are nearly empty, barely enough to cover a few weeks of imports. With elections approaching on October 26th, President Javier Milei is desperate to hold the line. For Bessent, the fear is clear. If Argentina collapses completely, it could fall straight into Beijing's financial orbit. But not everyone in Washington supports the move. Senator Elizabeth Warren has demanded answers from hedge funds over their exposure to Argentine bonds, suggesting the bailout protected Wall Street's profits more than ordinary citizens. For many Americans still waiting on delayed paychecks during the government shutdown, sending billions overseas feels like betrayal. But for Bessent, it's a necessary trade-off. A dollarized Argentina means another stronghold for Washington in Latin America, no matter the cost. Still, every dollar spent to keep Argentina afloat deepens questions about how long this can last. If the peso continues to fall, the U.S. may have to intervene again and again just to keep another nation from drifting away from the dollar's orbit. The $20 billion bailout might have bought time, but it also tightened Argentina's dependence on Washington. One of the key conditions of the deal ensures that Buenos Aires keeps its exports and reserves in dollars. A quiet reminder that in this global currency war, every act of rescue comes with invisible strings attached. On the surface, the policy looks like a guarantee of stability, but in practice, It's locked Argentina inside Washington's financial gravity. Every adjustment in U.S. interest rates now ripples straight into Buenos Aires. When the dollar strengthens, the peso weakens, and the cycle deepens. Global traders have already begun to smell blood. Hedge funds are wagering against the peso, confident that Argentina's central bank will eventually exhaust its dollar reserves. If that wall of defense breaks, another wave of inflation could explode, dragging the country back into another bailout negotiation. Bond yields hovering near 13 to 14% tell their own story. Investors see turbulence ahead. For the United States, this is more than an economic dilemma. Each lifeline extended to Argentina drains political credibility at home, stirring frustration among Americans already struggling with their own financial hardships. But the bigger risk is global. The more the U.S. uses borrowed money to stabilize weaker economies, the more it exposes the cracks in its own supremacy. As Washington scrambles to keep Argentina tied to the dollar system, Beijing is quietly exploiting the opening, buying soybeans, expanding trade, and tightening its influence across Latin America. Even American officials now admit their efforts to push China out of the region are falling short. The pattern is unmistakable. Defending the dollar abroad could end up weakening it everywhere else. While the U.S. pours billions into maintaining Argentina's alignment, China is turning that same instability into leverage. Days after Buenos Aires announced temporary tax breaks on agricultural exports, Chinese state grain companies swept in, purchasing around 35 cargos of soybeans directly from Argentine producers. No U.S. intermediaries involved. Argentina needed liquidity. China brought Yuan. For American farmers already hit by fading exports and falling global demand, the timing couldn't have been worse. USDA figures showed that U.S. soybean shipments to China plunged nearly a quarter in 2024, while Latin American imports surged. That new wave of Argentine deals rattled Washington so deeply that officials began discussing another $10 billion farm relief plan, a repeat of the earlier trade war subsidies. For China, however, every deal sealed in yuan cements its influence further. By keeping Argentina's export engine running and transacting in its own currency, Beijing is transforming America's rescue strategy into its own strategic weapon. The contrast couldn't be clearer. The United States spends heavily defending its currency, while China spends just as much extending its reach through trade. Each shipment eastward shows the world a different possibility, one where access to China's market could soon outweigh loyalty to the dollar. This quiet transformation is reshaping the foundations of the next great power struggle. Meanwhile, Japan faces a crisis of its own making. Over the last half year, the yen has tumbled nearly 6%, sinking to its weakest level in over 30 years. Behind closed doors, Prime Minister Sai Takaichi has made her stance clear. She favors fiscal expansion over defending the currency, calling interest rate hikes self-destructive. Her focus is on protecting exporters and fueling demand, even if it pushes the yen lower. But that approach has a steep cost. Each drop in the yen makes essential imports, oil, gas, food, more expensive. Inflation, which once sat safely under 2%, has climbed near 3.5%, eating away at savings and forcing families to spend less. Japan's debt mountain, now exceeding 1.3 quadrillion yen, about 260% of GDP, grows harder to control as bond yields rise. The Bank of Japan is cornered. It already owns more than half of all government bonds, while foreign investors hold barely 6%. If yields climb too quickly, the BOJ must buy even more debt, effectively printing yen to plug the gap. Every such move pushes the currency down further, creating a self-feeding loop of devaluation and inflation. Exporters may celebrate in the short run, but for ordinary citizens the reality is harsher. Rising prices, shrinking wages, and fading purchasing power. Japan now teeters between inflation and insolvency, and even its allies in Washington are growing uneasy. A continued yen collapse could send fresh tremors across global markets, already stretched thin by America's trade and currency battles. The fractures are spreading faster than Washington can mend them. China is weaving a new trade order built on yuan settlements. Argentina is drowning under dollar debt. Japan's financial footing is slipping under the weight of its own policies. The balance of global finance is shifting, and every attempted rescue only highlights how brittle the old structure has become. For decades, the dollar stood as the unquestioned anchor of global power. But now the contest for monetary control is underway. The next great crisis may not erupt on Wall Street, but in the very currencies that keep it alive. The question is no longer if America can lead, but how long it can afford to. Stay safe and subscribe for more global insight.